Okay, this is an additional video for test 3 review, going over a hedge on so setting up a forward contract to hedge a future payment. So it's the company has purchased product from a company in Belgium for 75,000 units at a price of $5.50 euros per unit, and they're required to pay for that merchandise in euros. The exchange rate on the date of the purchase, as you see down here in the table as well, it's $1.37. So it takes $1.37 to buy €1. The due date is February 23rd of the next year. So to mitigate the risk of any interest or currency fluctuations, they enter into a forward contract with an exchange broker. And the contract obligates the company to buy the 412,500 euros, again, that it's going to need to buy this product. And they're going to lock in at that price, which is $1.35 to buy €1 per euro. And assume it's a fair value hedge. Its functional currency and reporting currency is the US dollars. They give us the spot rates on the necessary dates down below, and then assume that all of the product is then sold out in 2022. So the first thing they'd like us to do is prepare our journal entries. So I'll come over here to the right. So on the date of the transaction, so notice up here in my columns, this is the transaction, what's going on with that accounts payable, and then this is the forward contract. So actually I'm gonna skip, whoops, sorry. I'm gonna put this down a line so I can do my computation up there. Okay, so if I calculate out my amount, so I guess pay attention to what I'm typing in here. But so we have 75,000 units times the €5.50 per unit times the $1.37. So that's going to be our dollar amount. So then it's going to go, whoops, it's going to go into inventory. Gosh, why does it keep? So we're going to debit inventory for the 565,125, and then we're going to credit accounts payable. And then on that same date, we enter into that forward contract, but on that date, there's no change. There's nothing that happened in value. So we're legally obligated to the contract, but there's no money to set up, so no record to be made. Then we get to the end of the year and we want to double check our values here and say, okay, well, what do we really owe on this accounts payable? So again, watch my formula. So now it's up to $1.40. So I'm still having to pay for the 75,000 units at the $5.50 euro per unit, and then now my exchange rate is up to $1.40. So now I owe $577,500. All right, I'm gonna move that back down here. Whoops, sorry. So then my accounts payable balance goes up. So then now I'm going to debit cost of goods sold, because again, we're assuming it's already sold for the difference. So 577,500 minus the 565,125 that we recorded above, $12,375 difference. And then the credit is going to go to accounts payable, because again, the goal at the end of the year is to have that properly valued. Now, our future contract also changed values. So then now it's a 4-cent difference. So if I do the math there, I'm going to take the 75,000 times the 550 per unit, now times that 4 cents difference. Now that's 16,500. It's going to go the opposite direction because again, I hedged it back at the 135. Now it's 139. So that broker is going to owe me the money. So the forward contract is going to be a debit. And that's going to be for 16,500. And then my credit goes to cost of goods sold. Again, because I took the hedge with them to protect my rates. So I'm only paying the $1.35 when all's said and done. But again, those rates are changing. Okay, so then we get to go back over here real quick. Our final date is that February 20th. So then we'll come down here and then we'll calculate out what is my liability on that date. So we want to get our accounts payable up to date. Sometimes, again, when I do it on the board, I do it in one entry, but I feel like the textbook wants you to do it in two, so I'm going to do it in two. So again, we've got our 75,000 times our 550 euros per unit, now times the $1.43. So that's what really we're going to end up owing. So we're going to debit our cost of goods sold, and again, for the difference. So 589,875 minus the 577,500, again, what we adjusted it to at the end of the year. So it's another 12,375 increase, and then we're going to credit the accounts payable. Okay, then we're also going to pay it though. So again, that's why I said when I do it on the board, a lot of times I combine them, but they want you to do them separately when you're doing it in your homework site or your test site. So then they're going to pay the full 589,875, what we just calculated above, and they're going to credit cash because that's what they owe that vendor that they made the purchase from. Now we'll come over to our forward contract and we'll true that up. So it's gonna go again, the 75,000 units times the €5.50 per unit times the the change, the difference between the $1.43 and the $1.39. So it's another 4 cents. So it's going to be the same entry we did above. It's not always the same. Again, it's just your difference in your cents. In this case, the cents changed 4 cents each time. But so just always double check that, how much it really changes. Okay, then we settle up that contract. So again, we have 2 entries going into that contract, both for $16,500. So that's how much that broker owes us. So cash comes in for the broker for 16,500 plus 16,500. So 33,000. Okay, and then we're going to credit it out of that forward contract so that is off of our books. Again, because contract's over, the exchange broker paid us cash, we paid our vendors, all is good. So then really you could just actually T-account these to get to the next answers that it asks for. But if we go back over here, it asks for your cash settlement. So what I always do is I know my cash settlement is what I hedged it at. So so when I go back to that, I hedged it at $1.35. So then if I take my 75,000 euros times the my 75,000 units times the $5.50 euros per unit times that hedged price, it's going to be 556,875. That's what I know I'm going to pay when I hedge it or enter that forward contract. If you want to look at your cash, look above, 589,875 less the 33,000 you got back from that broker, and then you want to sum those, you get the same answer. So however you want to, whatever makes sense to you to get to that cash settlement price is what you're going to do. Then again, with the cost of goods sold, I would T account it. So if we map out what happened, so let me, I don't want to move it. Okay, so if we merge that and underline it and say, okay, I'm gonna net my transactions, and I'll create a little T account here. Okay, so we know that if we go back up here at the top, it tells us that these goods in our inventory were sold in 2022. So 565,125 is going to get charged out to cost of goods sold. Then at December 31st, we have these two adjustments. So 12,375 is a debit with the change in the currency, and then it would come over here to our to our forward contract. Gosh, quit doing that. Come over here to that forward contract, and we credited it for 16,500. I keep pushing the wrong button. Okay, let me make these also in dollars and cents. Okay, then we'll come over and say, all right, now this is the end of the year, right? This is the end of 2022. What do I have? So I have what I charged off to cost of goods sold when I sold the product. I have the adjustment in the accounts payable at year end offset by my forward contract. So that would be my cost of goods sold for 2022. Then in 2023, I true it up, right? I have those final entries. So I have 12,375 when I true up the accounts payable. And then I have 16,500 when I true up that forward contract. And I get it up to what the current rates are. So then if I sum these, so my debit less my credit, that's my net cost of goods sold for 2023. And then my total cost of goods sold now when I get to the end after the whole contract is done and over and everything's paid for, it's going to be the 2022 amount plus the adjustment in 2023 minus the adjustment for that forward contract. And then notice that is also the cash you paid. So those two things are going to equal. But I wanted to show it to you just in that T account form so you can see that that's really a true statement. So after we do all those adjusting entries, dealing with our forward contract and our change in our currency rates, that's what it calculates out to.